We'll be going over IRS Form 8881, credit for small employer pension plan startup costs, auto enrollment, and military spouse participation. So there are a couple of changes to this tax form that was released in December of 2023. A couple of points of consideration based on the Secure Act 2.0 that was passed in 2022 with provisions that were to take place for the 2023 tax season. So the new things include an increased small employer pension startup costs credit. So eligible employers with 1 to 50 employees are eligible for a small employer pension plan startups cost credit equal to 100% of their qualified startup costs, subject to certain limitations. But previously, it used to be all employers would take a 50% credit. Now, employers with 51 to 100 employees still are subject to that 50% threshold. So we'll walk through some of these rules as they are explained in our article and in the form instructions, step by step. So that's one change. Another change is the employer contribution credit. So an additional startup cost credit is that you can now take a credit based on employer contributions, and we'll go over that criteria as well. And finally, a third aspect is the military spouse participation credit. So Secure Act 2.0 added a new eligibility criteria for employers who employ military spouses and as participants in their startup plan. So all of these are new changes to this tax form. If you are revising a tax return for 2022 or earlier, then you'll want to use the prior year IRS Form 8881. We'll put links to that video in the show notes. However, the article has been updated for the 2023 version of this tax form. And if you needed step-by-step guidance on the prior version, then you would have to probably go to the form instructions on the IRS website. But if there are any kind of one or two type questions that I can research for you, feel free to pop a comment in the comment section, and I'll see if I can dig up some of that information pretty quickly. So this still is a one-page tax form. It's got a little bit more substance to it than it used to. Part 1 still remains the credit for small employer pension plan startup costs. But there's also a caveat or an additional item for employer contributions, and we'll go through that step by step. Part 2 remains the small employer auto enrollment credit, which is still $500 for an auto enrollment option, which basically means new employees are automatically enrolled in the company plan, whether it's a 401k or a different defined contribution plan. And then part 3 is where we would calculate the participation credit for military spouses. And then you'll see that all of these have different lines to report these various credits on IRS Form 3800, which is the general business credit. So let's go to the top, and before we begin, we'll kind of go through how this calculation now works. So the small employer, the contribution, the employer contribution credit is a separate calculation from the startup costs credit. So the startup costs basically for 2023 and later If you have 50 or fewer employees, you receive 100% credit. If you employ 51 to 100, you're still at 50%. However, this credit is also limited to the greater of either $500 per employee, or sorry, $500 total, or the lesser of 250 times the number of employees, or $5,000 for the first credit year and the subsequent 2 tax years. So that's confusing enough in writing. Our example in part 1 will actually kind of walk through that calculation so you can better visualize it. So let's go ahead and start. So John Doe, he's the owner of Acme Enterprises. We've put that information at the top of the form. He's got 50 qualifying employees. So the first thing that we need to do is define what a qualifying employee is. And an employee happens to be someone that received at least $5,000 of compensation during the tax year prior to the first credit year that applies to the startup cost credit. So let's take a step back. This is for 2023. So qualifying employees would have to be someone that earned $5,000 or more of compensation during the 2022 tax year. So in this case, we put down 50 people, which means we are eligible for 100% of the credit, subject to the dollar limitations. So let's just assume that in line 1, we paid $10,000 to get this pension plan off the ground. So in line 2, since we have 50 employees or fewer, we simply carry that figure down. If we had 51 employees, we would have to multiply that by 50%. In line 3, we're going to enter the number of employees eligible to participate. So fortunately for us, we don't have any highly compensated employees. That's defined by the Internal Revenue Code, and those would be people that aren't eligible to participate based on that. So this 50 employee number is the number of non-highly compensated employees. So we multiply 50 by 250 and we get to 12,500. In line 4, we're going to enter the greater of $500 or the amount from line 3, which happens to be the line 3 amount, except we're not supposed to enter more than $5,000. So we're going to knock that down to $5,000. So now we enter the smaller of either line 2 or line 4. That happens to be $5,000. We're going now in line 6A, we're going to go through a calculation for employer contributions, right? So let's go ahead and start this off. We enter the 50 employees. They were all employees from the preceding tax year. Again, make sure that each employee does meet the criteria of having earned the $5,000 of compensation in the year prior to your plan startup. In line 6B, we're going to enter employer contributions to the plan. So this does not include elective deferrals. Those are employee contributions. It does not include contributions made to employees whose wages were in excess of $100,000. And then it does not include any contributions to an employee if you made employer contributions of more than $1,000. So the first is employee contributions. The second would be highly compensated employees. And then the second one, or the third one, requires a separate calculation, which we'll do in line 6C. So for all of that, let's just imagine that we have 40 of our employees that we made $1,000 employer contributions exactly. So we put $40,000, and now we've got the other 10 employees, and we put in $2,000 for each of them. So in line 6C, we are going to go to the instructions, which are offline. So the employer contribution credit limitation for the depends on A, the employer contributions, and then B, how many years you've had the plan in place. So you can enter no more than $1,000 if this is the first year or the second year of the plan. So that's what this means. We have 10 employees. Even though we contributed $2,000 on their behalf for each employee, we cannot put in $1,000 or more than $1,000 for each employee. So we arrive at $10,000. However, if this were the third year of the plan, we would be able to enter as much as $1,333 per employee. In the fourth year of the plan, we would be able to enter $2,000 per employee. And in the fifth year of the plan, we would be able to enter up to $4,000 per employee. So let me back up a second. The startup cost credit is only available for the given tax year that you start up the plan, and then the next two tax years. So if you created the plan in 2023, you could take the credit in 2023, 24, and 25. For the employer contributions portion of the startup costs, you can actually take that out up to 5 tax years. So if you're in the fifth year of administering this plan, then you would be able to claim up to $4,000 per employee on line 6C. On line 6D, we simply add everything together, the $40,000, the $10,000, and that gives us $50,000. So it looks like it would just be straight up 50 times $1,000, and we get to $50,000. But if we were in year 4 of this, then this amount would actually be $20,000, right? So just be careful on how the math works out, because even though you reach the same result, the different process might actually get you to a different result in subsequent years. So in line 6C, we can skip this because we have 50 employees listed on line 6A or less, or 50 employees or less. So we're going to simply carry this amount down to 6F. Let's imagine for a second that we have 75 employees. We're just going to use that number for these 4 lines of calculations. So what we would do is in line 6E1, we would subtract 50 from the number of employees. So if we had 75, we subtract 50 and we get 25. Now we're going to multiply this 25 number by 2%. So this is calculating the phase out that may apply for small employers with 51 to 100 employees. After 101 employees or more, then this credit is completely phased out. So now we're going to multiply the line 6D amount by this line 6E2 amount. So 50% of the $25,000 or $50,000 is $25,000. Then we're going to subtract that from the original $50,000, and that gives us $25,000. So we would then carry that number down to 6F. So that's how you would operate if you had to. If you had between 51 and 100 employees. We have exactly 50 employees, so we can take the full amount of this employer contribution credit, carry it down here. And now we're going to basically go through this based on the applicable percentages. So now this kind of gets us back to the mean. So if this is the first or second year of of the plan, then we're going to enter the amount from line 6F. That happens to be $50,000. But if we were increasing this amount, like if this were actually $50,000 from year 3 of the plan, then we would have to back that out by multiplying it by 75%, then 50% if it was in the 4th year, 25%. And so you still get to this magical $1,000 per year threshold. However, it becomes an increasing or a lower percent. You have to contribute more as an employer to qualify for that full $1,000 by the time you get to year 4 or 5. So that's why you've got in line 6C, we're making calculations based on $1,000, $1,333, $2,000 in years 4 and 5, 3, 4, and 5, or $4,000 in year 5, and then we're going to back that out by the appropriate percentage to get down to $1,000. But let's imagine that we're in year 4 and we still we contributed $2,000 per employee. So we'd be able to take the full $2,000 per employee. That would be $20,000, right? So, we're in year 4, so it's $2,000 per employee. But then when you come down here, we would have to multiply that $20,000 by the $10,000, and we would still get. Hold on, we would add this amount. It would be 60. This would be 60. And then in year 4, we would have to multiply the year, the line 6F amount by 50%. So the entire credit goes down from $50,000 to $30,000. And then if we took it a step further and said now up to $4,000 per employee, while we're in year 5, we only made $2,000. We can claim up to $4,000, but the $2,000 sticks. But if we're in year 5, that credit now goes down another 50%, and we're only able to claim $15,000. So this is kind of structured to where you're kind of being weaned off of the tax credit the further you go into the plan. And then by the 6th year, the plan's completely phased out. So let's get back to the calculations as they previously were. All right, so we have this $50,000 here. For line 7, this used to be reserved for future use. Well, this is the future use. We simply have a line as a placeholder for any credits that were passed through from a partnership or an S corporation. So most tax credits for pass-through entities just get passed on to the owner. So if your company owns another company and that company would be eligible for credits based on startup costs, then you would enter that here as it passes through to your company. And then in line 8, we simply add lines 5, 6G, so $5,000 up here, 6G, $50,000, and then the $5,000 here, and we actually come out to $60,000. So if you're a partnership or an S corporation, you would report that amount on Schedule K. Everyone else will report this on the Form 3800, Part 3, Line 1J. So now in Part 2, we're going to calculate the small employer auto enrollment credit. This really is straightforward. You're not really doing a whole lot of calculations per se. You either put in $500 or you don't, depending on whether or not you qualify. So you qualify in the first year that you include an eligible automatic contribution arrangement, and that is available for the subsequent 2 tax years as long as you maintain that auto enroll feature. You're not allowed any other credits for any other tax years for this. So in this case, we simply put in $500. We did not get any pass-throughs of other credits. So we're going to add those two. 500 plus 0 equals 500. So partnerships and S corporations will also report this amount on Schedule K. Everyone else reports it on line 1DD of IRS Form 3800. So now we're at the final part of this. This is part 3, the military spouse participation credit. So the first thing that you should know is right up here. Here's a pro tip. Anytime it says caution on a tax form, you should actually read it. So I don't say that facetiously or flippantly, but I do get a lot of questions from people where I find the answer right next to a bold caution statement. So if you have more than 100 employees in the preceding tax year, you cannot claim a credit for hiring military spouses. So we're going to stay at that same 50 employee threshold that we maintained, except 20 of those happen to be military spouses participating in an eligible plan. We discussed what eligible employers are. We discussed what what an eligible plan would look like. Basically, it's any defined contribution plan under which military spouses are eligible to participate no more than 2 months after they begin work. And if they are participating, they're immediately eligible to receive the same amount of employer contributions that a similar participant who is a non-military spouse would receive after 2 years. So basically, it kind of helps jumpstart the participation aspect of a military spouse. So they get a kind of a bump up. A military spouse that starts 2 months in gets the same benefit that someone who's not a non-spouse would receive after 2 years of service. And this really has to do with the vesting schedule of employer contributions. So to be considered an ERISA plan, you can either have a 3-year cliff where all of your benefits immediately vest at the end of year 3, or you can have up to a 5-year scale, which is probably more common, where 20% kind of vests every year until you get to 100% vesting after 5 years. So the other aspect is that your military spouse should have a non-forfeitable right to their accrued benefit. So basically, once you put money into their plan, that is not forfeitable. So a military spouse is an employee of the employer who's also not a highly compensated employee and is married to a member of the uniformed forces. So as an employer, you would be able to rely on the employee's certification that their spouse is indeed a member of the uniformed services if they provide the name, rank, and service branch of the spouse. So once you have ascertained that a military spouse is actually participating for purposes of the credit, you can then calculate that. So in this case, it's $200 per person that's eligible, that's participating, and then it's also up to $300 per employee for the employer contributions. And this is above and beyond what we calculated in Part 1. So again, there's a placeholder for any small employer credits from partnerships and S corporations that were reported to you, and then you combine everything in these lines. We come up with $11,000. Partnerships and S corporations would report this on Schedule K. Everyone else will report it on Schedule 1EE, just below the auto enrollment credit. So we did go over a lot. This is all we have for this tax form. So we'll go, we do go into depth in the article as well. We'll put links in the show notes to both the article and if you need reference to a walkthrough for The prior form, we'll keep that up on the on the YouTube channel for as long as amended tax returns can be used, or that form can be used for amended tax returns. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there's a topic that you'd like to hear discussed in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.